Hello and welcome everybody to the channel. Today, we're going to find out if one of the greatest companies on the planet is a buy right now. That company is Aapl, ticker symbol AAPL. Aapl needs no introduction, but let's talk about them anyway. Aapl has grown to become the most valuable company in history. Their flagship product, of course, is the iPhone, which did nearly $40 billion in Q3 sales alone in the most recent quarter. To put that in perspective, fellow Dow Jones Industrial stocks, Salesforce, Visa, McDonald's, and 3M, among others, didn't even do $40 billion in revenue for their entire last reporting year. Aapl is truly incredible. The iPhone itself is enough to provide Aapl with an almost impenetrable moat. As Warren Buffett says, people would give up their cars before their iPhone. It's just one part of their massive ecosystem. That ecosystem fortifies Aapl with a strong network effect. Think iMessage, the App Store, and how each of their products seamlessly leverage one another. That also raises switching costs once in the ecosystem. However, I think the most exciting part of Appl's business is their services segment. It is their fastest growing segment. Q3 was 8% year-over-year growth and has something investors love, subscription-based revenue. They have also crossed over 1 billion paid subscribers for their services. These include the App Store, Apple Music, iCloud, Apple Pay, Apple TV Plus, and a lot more. The services segment generates over 70% gross margin, and that includes most likely a loss from their Apple TV Plus. While Apple doesn't report Apple TV Plus separately, if it is like other streaming services, it is probably still not profitable due to the heavy amount of investment required to launch a streaming service. And the segment overall still generates 70% gross margin. It's amazing. I see that growing as their newer offering becomes profitable over the next few years. So what does that mean for their stock today? Is it worth buying at a trading price of $182.91? Well, to find out, we're going to look at 4 different valuation models: discounted cash flow, dividend discount, exit multiples, and Ben Graham's valuation model. Full disclosure, I do own shares of Aapl, and this is not financial advice. All right, let's discuss how we're going to analyze this stock. Please, if you haven't already, hit that like button and subscribe to the channel. Also, hit the notification bell so you can be informed when I upload more stock analysis videos. So we start here on our investment summary page, and this just gives a quick overview of the company itself. You can see that Apple's close to their $3 trillion in market cap. I do expect them to hit that probably the end of this year or later next year. And we can see that they're S&P 500, NASDAQ 100, and a Dow Jones member. And their price right now is at $182.91 with a trailing 12 EPS of $5.95 a share. They're also trading right now at a PE of a 30.9, which is actually slightly above their 5 and 10 year averages. In fact, all their valuation ratios are above their 5 and 10 year averages. However, I do think Apple, they traded a premium, plus people are starting to recognize that Apple is more of a technology firm instead of a consumer product company. So now they're trading at higher and higher PE ratios. And if we come down here to the profitability, we see that gross margin percent, 43.45% in total, which is well above their 5 and 10 year averages. Operating margins also very healthy at close to 30%. And they have a free cash flow margin here of 26%. That's absolutely incredible. 26 cents of every dollar Apple earns is converted into free cash flow. And then that generates a yield of 3.3%, which is actually slightly below their 5 and 10 year averages. But down here, we can see how effective management really is at allocating their capital. They have a return on assets of almost 30%, a return on invested capital of 56%, which is massive, and a return on capital employed of 53.42%, all well above their historical norms. Currently, they pay a dividend of 96 cents a share, which yields at about 0.5%, which is pretty much below their 5 and 10 year. And they only have a free cash flow payout of 15%. All pretty decent metrics. And then if we look at how healthy they are, they have a current ratio of 1, quick ratio of 0.9, debt to equity of 1.8, which is slightly high for companies that I like to invest in. However, it's Apple, and we can see here that their interest coverage is 30.6, so I'm not too worried about them covering their debt payments. Okay, so if we look at how they've performed historically here, the last 10 years, they have grown their revenue per share at 15%. They decreased their gross margin a little bit, just under 0.25%. I'd like to see this number going up. You can see in the 1, 3, and 5 years, though it has increased, and it's probably going to keep increasing due to their very profitable services segment. Their OpEx has also margin has also grown a little bit at 0.75, but they're starting to get that back down. So that's a very good sign going forward. Earnings per share. This is diluted earnings per share. They've grown that 14.5% per annum for the last 10 years. And you can see here they have a very aggressive share buyback program. They're one of the best share buyback programs in the entire country, just under 5% per year. And they've grown their dividend at 16.5% per annum over the last 10 years. Free cash flow, also very healthy growth at over 15%. Taking a quick look at their charts year to date, you can see that they're up 41%. You can see the line here year to date. There's not been a lot of buy opportunities this year. However, they did have a dip along with the rest of the tech sector in August. We can see that got down to 174. Fortunately, I was able to scoop up some shares there, and they're coming back down again. They did have a pretty big drop of about 4% yesterday. And we'll see what happens today. However, I do think that there's some good value to be found here. Over the last 10 years per year, they've grown at 26.29%, well above the S&P 500. And I definitely expect that kind of growth to continue over the next decade. We can see if we look at their 5-year chart here, there's always a lot of opportunities to buy Apple, especially, before 2023 started, they were pretty low, and during the recession-ish of 2022, and we can see here back after the COVID times, they also had some good buy opportunities. So Apple goes on sale quite a bit. Coming over to their charts, we can see some pretty good charts here. So you can see they've just consistently grown their revenue, consistently grown their net income. Their SG&A margin has stayed relatively steady. It's just under 7%. Their operating margin has slightly increased a little bit, but you can see since about 2020 it's come down a little bit, and their operating income margin has come down a little bit, but since 2020 it's increased a little bit. So these are some positive signs. Their earnings per share, nice, very healthy growth there, and you can see their share buyback program reflected here in this chart at the bottom right, with just every year a nice little decrease in the shares outstanding. Looking at these same charts on a quarterly basis, you can just see how consistent that share buyback program is. All right, so coming over to one of my favorite charts, we can see just steady growth in free cash flow every single year. That's always good for the companies we want to invest in. As well as we look at their cash, it has had a little bit of a burn the last few years. I do think that's due to the investment in streaming and some of the investments they plan on making into that realm in streaming going forward, but I'm not too concerned about that. Finally, we come over to some per share and valuation charts. This is what I like to see. Their free cash flow, just consistent increases. In fact, it looks like they're accelerating their increase in free cash flow per share. And of course, you can also see their revenue per share has increased nicely. Again, that's a lot due to their share buyback program. Okay, so we come over to the most artful part of our evaluation. That's estimating the growth rates. This is always tricky. So when I estimate growth rates, I typically look at management guidance as well as analyst estimates. I knock a few basis points off, and then I kind of just go from there and make sure everything looks reasonable in the end. So to estimate the fiscal year end here for September 23, pretty much the one last quarter of the year for them, slight drop in revenue, 2% year over year, net income margin of 25%, earnings per share of a slight increase of 5.25%. They are converting their operating or cash at $1.13, which means how much cash net income do they convert into cash? And I estimate a CapEx expenditure of 3.5%, which gives us a free cash flow for this fiscal year of $102 billion, an increase of actually a decrease here of 8.5% from last year, and a margin of 26.7%. All right, so coming over to their projections for the next 10 years, I am very bullish on Apple. I think that they are not only transitioning into their services segment more and more and reaping the rewards of that high gross margin as well as the subscription-based revenue models. But some of the products they have in their pipeline, I think, are going to be game-changing, just like the iPhone was a few years ago. And that's the Apple Car. The Apple Car is slated for release in 2026, and that's going to directly compete with Tesla. And no matter how great Tesla is, and I think Tesla's a wonderful company, the competitions from Apple will be fierce. And so if Apple is anything like their historical norm, which I expect them to be, they're the best run company in the world, they will take market share from Tesla, and that will be realized in some of these growth rates here. So looking at that, we do have a 6% in year 2 revenue growth, 7% in year 3, year 4, 9%, year 5, 11%, and then thereafter, so years 6 through 10, I'm projecting a 10% per year revenue increase. That gives us a CAGR here of 7.91%. It's slightly under what their historical norms are, but again, I think it actually might be better. We'll see when the Apple Car gets released. The earnings per share growth, 8.25%. Year 2, 9.75 in year 3, 11, 12, and then 12% thereafter. And this, to me, reflects a very bullish stance on Apple, especially with what they have coming down the pipeline. That is a 9.87% compound annual growth rate for over those 10 years, which is, higher than their 1 year here, but well under their 3, 5, and 10 year historically. For the net income multiplier, I used 85%, and the way I determined that was I look at how their net income growth is compared to their earnings per share growth. I see that it's relatively 80 to 90% below what the earnings per share growth is. So I just put in 85%, split the difference, and that gives us a net income margin here of 25.83% by year 10, which we can see if we look at the last 8 quarters up here is fairly in line with what their historical performance is. And to me, this could actually be higher as they get more efficient and more profitable. And finally, so for the cash conversion, I did $1.25. And again, that's pretty in line with their historical averages here. A CapEx percent of revenue of 3.5%. And what does that give us for free cash flow? So for free cash flow, we're growing at 8% per year over the next 10 years. A free cash flow margin of 28%, which again, very in line with what their historical norm is. And this could also be higher. I like to be a little bit more conservative. Maybe their free cash flow margin could be 30 to 32% in the next 10 years. All right, so where does that leave us for our discounted cash flow model here? So we take those numbers from the growth rate tab, plug them into our discounted cash flow model, and we can see here our present value of the free cash flow combined with our exit value gives us a intrinsic value of $3.3 trillion. And with 15.7 billion shares outstanding, that gives us a discounted cash flow price of $210 per share, which is an upside of 15% over the current share price. Also, I should mention that I'm using a discount rate of 8%. I use 8% because I believe with inflation factored in, that nominally my return will probably be 10 to 11%. And I think 8% is a very fair discount rate. For our dividend discount model, this is a very low valuation. You can see the final price here is 89.9. I do factor it in. I'll talk about how I weight it later. We can see they've had a couple stock splits over the last 10 years, and I'm only looking at about a 5, 6, 8, and 10% growth for their dividend. Apple doesn't seem to grow their dividend very fast, but with their low free cash flow payout ratio, I put in a 7% perpetual dividend growth, which I can see Apple easily doing year after year. All right, so for their peers selection here, I went with Microsoft, Adobe, Netflix, Cisco, and Tesla. And some of the reasons behind these comparisons are Microsoft, I think, is obvious. Adobe is a software company, which Apple has a lot of software in their suite that's similar to Adobe. And I chose Netflix because Apple's really trying to get into that TV streaming game, and in the next couple of years, they're going to be making some acquisitions, I think. They're really pushing into the live sports world for the streaming. And if you've ever seen Apple TV, they do have very good content on their channel. Tesla, now this may be a bit premature. However, once the Apple Car drops in 2026, Tesla's going to become a direct competitor. So I'm just kind of throwing in Tesla there now just to see how it all looks together, thinking about the future here. And that gives us an average PE of these companies of 45.09 and a median PE of 47.7. And I think I'll be a little bit more conservative. I'll use the average PE. That gives us an exit multiple price here of $268.26 a share, which is an upside of 46%. And finally, we have Ben Graham's valuation model. Currently, the year one earnings per share is estimated at $6.02. 7 PE for another growth company. I'm projecting a next 5-year growth rate here of 7.78%. For their earnings per share, the average AAA corporate bond yield is 4.4. Currently, it's at 5.03, so historically pretty high. And that gives us a Ben Graham valuation price of $77.82 a share, which is a downside of 57%. All right, so coming back to our final step here, looking at the final valuation, we have a discounted cash flow of $210.31, dividend discount of $89.90, exit multiples of $268.26, and Graham's valuations is $77.82 a share. So with the current share price of $182.91, what is the recommendation? Well, before I do that, I do want to make a quick note on how I weight my valuation average. I take 55% weight for our discounted cash flow, a 10% weight for our dividend, 30% weight for our exit multiple, and a 5% weight for our Ben Graham's valuation. And the reason I do this is I've found over time that the dividend and Graham's valuation models tend to be very extreme. So I'm trying to kind of smooth out these averages here. So what does that actually give us? Well, let's see. That brings us to a valuation average of $209.03, a potential upside of just under 14%, and with a 5% margin of safety, that is an acceptable buy price of $198.58. I use a 5% margin of safety because I'm very confident in Apple's future. They are the best run company in the entire world, and they continually innovate and they continually release just great new products year after year. So with the news over the last couple of days of Apple's products being banned in China for government use, I don't think that's really going to affect them long term. Their share price has dropped a little bit, 4% yesterday. We'll see what happens today, but I think right now is a great time to pick up some shares in Apple. They're always going to be trading at a slight premium, and just going forward, people always doubt them. People always doubt the potential for growth, especially for big tech, but year after year they deliver and they just compound those returns for investors at such a great rate. All right, well, that wraps up today's discussion. Thank you everybody for watching this episode. Let me know what you think. Is Apple a buy right now? Is it undervalued in the current market? Do anybody out there own Apple shares? And what do you think? So let me know your comments below, and also please hit that like button. Don't forget to subscribe to the channel. Happy investing.